Welcome to the Winnie Podcast. This show is focused on empowering ranchers. Whether you're a seasoned rancher or just getting started, we'll guide you on how to use the infinite banking concept as an alternative way to finance your operations. It's a better way to think about money. Join us as we discuss planning for the future, attracting the next generation, and the art of keeping more money within the family. Here's your hosts, Winnie and Lacey.
All right. Hello, everybody. We are back for part 2 with Mr. Chris Thompson, who is joining us from Saskatchewan, from his home office, and kind enough to really take our education to the next level as it relates to trusts and how to implement them into our lives. Because we had our first session that would have just come out recently. So please go back if you want to know and you know nothing absolutely about trusts. I think our part 1 is a really great place to start. Part 2 is all going to be about how to really implement those trusts. And he's going to walk us through an example and use an analogy to really help us wrap our mind around how a trust can truly be used right here in Canada. But before we get going, we want to set the stage a little bit. And it's really going to be about who is this for and who is this not for? And so as I'm learning from Chris, at first I thought, is this only for people that have corporations? And actually, no, it can be simply for people who are in sole proprietorship, right? And Chris is going to let us know at one point how those trusts work for us sole proprietorships and people who actually have a legal partnership as well. And again, Chris is going to expand a little bit more on that. And then I think also how we're going to set the stage is just give a basic, overall overview on some terms that Chris is going to use. And I wish that was sort of done for me because I know my brain kind of works like, oh man, I have no idea what that means. And now my brain is stuck at what does that mean? And then not pay attention to anything else. So one of the first terms that Chris may throw around is estate freeze. And so what is that really quickly, Chris?
Yeah, an estate freeze is just you're freezing the value of an asset, Winnie. So in many cases, it's a private company share. We freeze the share at the current value. And then we pass on future growth to the next generation. And I'm going to talk about that in an example. A freeze could be, we don't have a corporation today, but we take assets and we transfer those into a corporation, a brand new corporation. And then freeze it. And then future growth of the assets is in the next generation. So it's all about trying to mitigate a tax liability and pass on future growth and future taxes to another generation. It's very commonly used that way.
Who can perform an estate freeze?
You generally have it done through your accountant or your tax lawyer or a lawyer. So as an investment advisor or an insurance advisor, we certainly don't perform that function. We can talk about where they might be useful, which is what we're doing here today. But your accountant or your tax people would do that.
Okay. Helpful to know. Okay. The next term is Section 85 rollover.
Yeah, Section 85 rollover is just a section of the Income Tax Act, and there are a number of sections that are used in a freeze. A common one is the Section 85, where we're rolling assets into a brand new company. The Section 85 allows us to roll those assets in at original cost, so there's no tax on that transfer. And then we freeze that value today, and the shareholder takes back a note or a promissory note for the value of those or for the cost base of those assets. And now the company owes the shareholder that money. But future growth of those assets now is onto a next generation.
Okay, perfect. And then you'll also mention, I believe it's a Section 88, which is like
Section 86. Section 86 is we're not transferring shares into a brand new company. And maybe I'll leave that for the example. You'll see how a Section 86 works.
Perfect. And then what does like a holding company do in the context of what we're going to be talking about today?
You know what? Let's leave that for the example because I think it's pretty clear what the holding company does when we get into the example.
Okay. Do you think that there's any other terms? Like I know you got the curse of knowledge here. So do you think that there's any basic terms that maybe a non-specialist like yourself might need to know before listening in on what you're going to share today?
when you hear accountants and tax people throw around sections of the Income Tax Act like 86 or 88 or 85, it's just important to know what it is they're talking about or what they mean by that. Things like cost base. What does cost base mean? Well, that's what you acquired an asset at. That's a cost you acquired the asset at. When people talk about FMV or fair market value, that's what the value of that asset is today. Estate freeze is what we just talked about today. The freeze is freezing the assets at their value today, passing on future growth to the next generation. So I'm going to provide an example here, a fairly simple example that should make some of those terms and some of the mechanics of that whole process much clearer.
Yes, amazing. And so with that being said, just one last thing to really set the stage here. So for all of you listening on, something that are just Spotify or you're just listening inaudibly, today is a little bit different because Chris is actually visually sharing some slides. So if you happen to be listening to this, I hope you can catch as much as you can by listening, but it is actually best if you tune into our YouTube podcast and YouTube channel so that you can actually see the whole thing today. All right, I'm going to hand it over to you, Chris, and we'll go from there.
Well, I'm going to share my screen now, Winnie. All right, folks. Here's what we're going to talk about today. Is one of the big questions that accountants, tax lawyers, we get in our industry is how do we transition the business on to the next generation, if that's what the plan is. Or the wealth onto the next generation, and how do we try and minimize or mitigate our tax liability? Because as a business owner, whether you're a farmer or a rancher or a business owner in some other industry, you've grown that business from a small number to a fairly significant number in a lot of cases. So the question is, how do you mitigate that tax liability and how do you transfer future growth onto the next generation? The one thing that's different for ranch and farm families is the ability to roll qualified assets onto the next generation without tax. That's very, very unique to the ag industry and ranching industry. That's not available to the other industries. We're not going to get into that in detail today, but that's one thing that farmers and ranchers have that is a significant benefit.
And that's all across Canada, Chris?
It's right across the country. Yeah, exactly. So here's what we're going to start with is that, what sort of planning you would do and what sort of tools you might use or what sort of corporate structure you might use or consider really depends on where your company is at in the evolution of your business. So a startup is a fairly simple thing. A lot of people start up as a sole proprietorship. They borrow some money, they personally guarantee that debt. And we're really concerned just about survival. Can we generate enough revenue net of expenses to pay our lifestyle expenses, reinvest back into the business to grow the business? And then we get into the growth stage of the business. The growth stage of the business, we've survived that setup stage, and now we're making some money. We might be making more money now than we need for lifestyle and to operate the business. The business owner is a little bit older. The kids are a little bit older now, and the kids might be saying, "Hey, mom and dad, how do I get involved in the business, or is this something that I can take over?" So those kinds of questions might be coming up. Now we're looking at things like business continuation and also tax planning. Because you've grown a company or an operation from a small number to a large number. Again, if you're not a farming or a ranching company, you can't transfer that tax liability on to the next generation. Therefore, we have to figure out how we're going to deal with the tax liability so you're able to transfer that business on without having to sell business assets or personal assets. And then finally, the established business. That's where you definitely have the shareholders are at the door of retirement or semi-retirement. You've got the kids that might be in their 30s or even 40s, and they're really anxious to sort of take over the management responsibility and the reign of the company and the ownership of the company. We might have philanthropic interests that the clients might be interested in exploring. So we're really at that point where we have to make some decisions as to what we're going to do with the business and how we're going to deal with the tax issues. So there are a number of different entities, ladies and gentlemen, business entities. You're certainly familiar with all these terms. So sole proprietor is, as Winnie has said, is the simplest entity. It's you are the business is you. You generate the income, pay the expenses, and report the net income on your personal tax return, the T1 return. So many people still are, especially in the ag industry, still are sole proprietors. Then you have partnerships. You certainly see in the ag industry, there's a number of partnerships. Usually it's mom and dad are partners, and a partnership is not a taxable entity; it's a legal entity. But it's really used for a way of splitting income business income between partners. So the income comes into the partnership pays the expenses, the net income is distributed to the partners. In many cases, those partners are just mom and dad. So it's a way of splitting that income. An operating company is a company that has an active business. That might be farming, ranching, selling cars, creating some sort of product. And those operating companies have the advantage of a very low tax rate on a certain amount of income. So generally across Canada, the first $500,000 of income, and that's active income. That's business income is taxed at a very low rate, which is much, much lower than the personal rate. So a question that's often asked is when do you incorporate? Well, one of the things to consider is if you're generating more income than is necessary to pay for your own lifestyle expenses, and you're paying a high tax rate on that, it might make sense to incorporate, pay a much, much lower tax rate that gives you much more income to reinvest back in the business.
So,
go ahead, Winnie.
So I was gonna ask here, just because it seems relevant. It seems like here in Alberta anyway, I think there's like a documented over 100,000 individuals that are married to an American. So I know it's more than what you can cover today, but what would it be? I don't know, to the best of your ability, like, is it advised to, like, if you're an American, to have like a corporation?
Yeah, when you can still have a corporation, but there's other wrinkles that you have to consider when it comes to wealth transition planning, business transition planning, and tax planning. And I know you've done a session with our tax lawyer, Brian McNulty, and Brian addressed this to some extent as well in that podcast. But if you're an American citizen and you retain that citizenship, doesn't matter where you live in the world, you're always going to be an American citizen and subject to U.S. tax rules. And there are certain reporting obligations as a U.S. citizen, even though you may not have lived in the U.S. for a number of years, and also on death. The way you're taxed on death, you're taxed on your worldwide assets. Right now, under the new American administration, there's a $15 million exemption to that limit. But if you're a very high net worth family, where you're beyond that $15 million, then you really have to consider what you can do to mitigate that tax liability. So the U.S. citizens, I'm not going to get into that in any detail today. That's a very complicated, complex area.
Yeah, for sure. I think the only thing I would add here is that at the time of this recording, it is August of 2025. So that's the most up to date up to this point to what Chris is talking about. And I guess we would also just say many times over to those Americans, it's just what's really, really more important is that we do advocate for you to keep up to date with the filing of your taxes, to keep it simple, not only for yourself, but for your family. And in the future, like your future self will thank you if you do that on a consistent basis.
Yeah, you just asking your tax advisor, your accountant, how does being an American citizen impact your planning, your business planning, your wealth transition? Asking those questions is very, very important if you're an American citizen. A professional company is just another form of an operating company. A professional company is owned by doctors, lawyers, other professionals, accountants, and usually the association or the college has certain requirements as to who owns shares. So for a doctor, for example, the doctor or a licensed doctor must own the voting shares of that company. So a professional company is just another operating company, but it does have certain rules around it. Holding companies are companies that generally own investment assets, but also can own shares of operating companies, or not necessarily professional companies, but operating companies. So we're going to talk about where a holding company might come into play in typical planning today. And trusts. Last time when I spoke with Winnie in the podcast, we talked about trust, generally what a trust is, what the types of trusts are. Today, we're going to talk about how a trust is used in the transition of a family business and tax planning. And finally is something called a joint venture. A joint venture is not a legal entity, it's not a taxable entity, but it's an agreement between parties to participate in a venture or projects of some sort. And when that project is over, then the joint venture ends. So it's not a taxable entity. It's not a legal entity.
Okay. So sorry. So basically for a sole proprietorship, partnership, and joint ventures, they're all taxed at personal rates?
The partnership would, but again, the partnership, let's say mom and dad are the partners. So the partnership earns the income, pays the expenses, and then sends the net income to the partners and whatever percentage of the partnership they own. So it could be 50-50.
Right.
Sole proprietor is, the sole proprietor, the business is the proprietor is the business. So you earn the income, pay the expenses, and then you report the business income on your personal return. A joint venture doesn't report any income, doesn't pay any taxes, and it's not a legal entity. It's an agreement between parties in a particular project.
Right. So then the operating companies, professional companies, and holding companies and trusts are taxed at, just the three. Operating company, professional companies, and holding companies are taxed at corporate rates?
Yeah, let's talk about that. With an operating company, whether an operating company or professional company, and you're earning active income. In Alberta, I'll give you an example in Alberta. If you're earning active income, so active income is the income the company earns from doing whatever it's doing. So whether it's providing medical services or selling cattle or grain, that's active income. And in Alberta, you're taxed at 11% inside the company on that active income, up to $500,000 of income. And if you earn more than $500,000 of income, you're taxed at 23% on the income above $500,000. So up to $500,000 is 11, above $500,000 is 23. Your top personal rate in Alberta is 48. So you can see the advantage right there of incorporating. An 11% tax rate is a far cry from a 48% tax rate when you're earning significant income. And that's why a lot of people incorporate. A holding company is taxed on investment income. So the holding company owns shares that pay dividends or investments that pay investment income of some sort is taxed right from $1 at the top rate in Alberta at 46.67%. In Saskatchewan, BC, Manitoba, it's 50.67%. So it's taxed at a very high rate on investment income. Holding companies don't generate active income. They generally generate investment income if the assets are generating income at all. And then trusts, depending on the nature of the trust, most trusts are taxed right from $1 at the top personal marginal rate. So Alberta has 48%. So we're going to get into an example here, Winnie, of how these sort of come together. So are there any points you want to make before we get into the example?
Nope, not at all. Just go right on ahead. Thank you so much.
So this, gang, is an example I'm going to use, fairly simple example from a television show. I'm a product of the 70s. So this is a television show that was really a great program. It was called Sanford & Son. And those of you that are of my generation may remember the show. There was the lead guy was a fellow by the name of Fred Sanford. And Fred owned a company called Sanford & Son Salvage. And Sanford owned, Fred owned all the shares, the common shares. And when you hear the word common share, that's a growth share. So all the growth of the company is in those shares. And so until he does anything differently, all the growth or the losses are all attributed to Fred shares. So Fred's now, as you can see, and I remember from the television show, Fred's getting a little older here and got a gray beard, and he's owned this company for a lot of years, and the company's done really, really well. He's really good at buying and selling junk. And you remember the show, Fred always complained that he was having a heart attack. He was going to move on to be with his wife. Was it Elizabeth? I think her name was. So he always thought he was going to die. So it's certainly time for Fred to die. He's at that mature, established stage where he's been around a long time. He's older, and he's got one son, and that son's name was Lamont. And Lamont is an employee of Sanford, but he doesn't own any shares or equity in Sanford. So as you can see, Lamont is probably in his 30 years old or 40 years old here. Lamont has been asking Dad, hey, Dad, if you were to die or if you were to retire, I love the junk business. I think I'm pretty good at it. So I'd like to take over the business. So that's what Lamont is telling Dad. And that's not a uncommon story. You certainly see at this stage of the game, if the kids are working in the business and want to take it over, they're certainly asking their parent, what's the plan here, Mom and Dad? How do I get involved? Now, Lamont is involved, but he's merely an employee at this stage. Fred does not want to give Lamont any equity directly at this stage, because even though Lamont's in his 30s and should be mature, those of you that remember the show, Fred always referred to Lamont as the big dummy. So if Dad is referring to his son as the big dummy, it just means he doesn't have a lot of confidence in him. So he doesn't want to give any equity to Lamont because he's worried about, is Lamont mature enough to own equity in the business? Who might he meet and marry? And if that marriage ended in divorce, what would happen to the equity in the business? So Fred is concerned about that. So Fred takes this story, this situation to his tax advisor and said, okay, I've got this situation where I've got a company of value here. I'm going to use a value of $2 million. And he's growing it from nothing. So he's got a capital gain there of $2 million if he were to die today. He's got a son that is anxious to figure out what the plan is. So how does he get involved and how does he take over equity? So he goes to his tax advisors, and the tax advisors help him establish kind of what his opportunities are. And so Fred's objectives are, and Fred wouldn't necessarily know what these objectives are at the time of the meeting. He just knows he wants to figure out how he's going to transition this business on to Lamont at some point without doing anything today, but continue to generate income for himself. So the first thing that he wants to do is he wants to fix the current tax liability embedded in the value of salvage shares. So salvage shares today are worth $2 million. One thing Fred didn't know is he could actually fix that $2 million or freeze it. So that $2 million will not grow anymore, which means that his tax liability doesn't grow anymore. He wants to preserve that lifetime capital gains exemption opportunity. All residents of Canada that own private company shares, if those shares are qualified and meet the requirements to be a qualified share, you get a $1.25 million capital gain exemption. So on $1.25 million of that $2 million of growth, he wouldn't have to pay tax on that. So that would save him between $300,000 and $400,000 of tax. So that's a significant opportunity. He'd like to be able to multiply that capital gains of exemption if possible. So can somebody else take part in it? And only an individual can take part or take advantage of a lifetime capital gains exemption. So who else we got in the picture here? Well, we got Lamont, but we don't want to give Lamont any shares. So there might be a way to structure this where we can give Lamont or pass some of the gain on to Lamont without giving him any control and get the capital gains exemption in the Lamont's name as well. One thing is happening right now is Sanford and Son is generating significant profits. So Fred's getting a little older. He's taking his profits, and when he was younger, he'd take his profits and just go back and buy a bunch of junk for sale. But he's slowing down now, and rather than taking that profits, he's leaving the profits on the table in the company and investing that in investment assets in the company, not active assets. So that's going to cause a problem now, because if we have too great a percentage of investment assets inside the company relative to active assets, we might not get the capital gains exemption. Also, there's some procedure by creditors and so on. So we want to get those investment assets out of Sanford somehow and into another entity without creating any tax for Fred. The other thing he wants to do is he wants to potentially transfer future gains and ownership to Lamont. So Lamont certainly wants to own the company. Fred's not certain yet that he should, but he wants to create a structure that will allow that to happen at some point without putting himself and the company at risk. And then finally, Fred says, whatever you do, whatever structure or whatever recommendation you make sure that I maintain control here. I'm in control. I need to continue to generate income for myself. And I just don't want to make any mistakes here where I do something where I could expose the company and myself to risks that I don't have today. So that's essentially what Fred wants to do, Winnie. So what would a tax advisor potentially recommend here? And this is an example of a Section 86 freeze. So it's not an 85. An 85 is a little different structure, and we won't get into the differences here today. But in the Section 86 freeze, what we're going to do, where's my pen? We're going to freeze the value of Sanford and Son Salvage at $2 million, because that's what its value is today. We're going to set up a new trust, a family trust, Sanford Family Trust, and a new holding company. So what we're doing is we're freezing Sanford and Son. We're putting the growth shares or the common shares in this new family trust. So Lamont, Fred, and the holding company are all beneficiaries of the family trust. And so all the future growth of Sanford and Son Salvage from this point on is now in the shares that are owned in the trust. So down the road, the company might grow to $4 million of value. But what would Fred be taxed on? He'd be taxed on the $2 million of value. So in giving up $2 million of growth shares to the trust, he takes back $2 million of fixed value preferred shares. So whenever you hear this term preferred shares, those are usually fixed in value. A freeze has often been done, and those shares aren't growing in value anymore. The growth shares are in the trust. So have we accomplished some of these goals here? When you take a look at the first one, have we fixed the current tax liability? Yes, to some extent we have, because if Fred dies or if Fred sells the company, where's the tax liability? It's in these $2 million of shares. So if he's sold the company today, that's a $2 million gain. If those shares were qualified for the capital gains exemption, $1.25 million of that would be exempt from tax. So only $750 would be taxed, or half of $750. So you significantly reduce the tax liability if those shares are qualified, but there are very strict requirements to make those shares qualified. So that we have fixed that liability. The other thing we don't know for sure, though, is we've set up a new holding company of which Fred is 100% shareholder. So we don't know what the value of that company is going to be or what's going in that company. But let's say we had $500,000 of assets inside that company. That would be $500,000 capital gain to Fred, half of which is taxable. So there'd be about $125,000 of tax due there. But we've done a big job in terms of fixing the current tax liability. Have we preserved the capital gains exemption opportunity? Yes, we have, because in order to get the capital gains exemption, we have to make sure that the shares of Sanford remain qualified. So that means that the majority of the assets in Sanford must be used in the active business. So we have to get investment assets out of Sanford and move it into another entity, so we don't sacrifice the qualified nature of the assets. So the way we do that now with this structure, we're able to move investment assets from Sanford through the trust. And because the holding company is the beneficiary of the trust, we can move the assets into holding company, and that can be done tax-free. So now Fred has his investment assets, has his insurance, and so on inside the holding company, and he's keeping Sanford and Son pure for the purpose of the capital gains exemption. Can we multiply the capital gains exemption opportunity? So if somebody came along and bought the company or bought these shares, what are they buying? They're buying Fred's preferred shares of Sanford, and they're buying the common shares or the growth shares from the trust. So Fred can utilize the capital gains exemption on his preferred shares. What we do is we have a capital gain inside the trust. And what the trust allows us to do here is distribute the gain to other trust beneficiaries. Well, who's another trust beneficiary? Lamont is a trust beneficiary. So we can distribute a $1.25 million capital gain to Lamont, even though he's not a shareholder today. We distribute that gain to him, and he can utilize the capital gains exemption. So here's where trusts are very, very useful, because now we can multiply the capital gains exemption under today's tax environment and spread it among a number of family members. And if Fred had other kids or a spouse, he could do that with the other kids as well. The other thing now with the next point is transferring future gains potential ownership to Lamont. Can we do that? So if Fred passed away, he'd have the preferred shares and the trust would have the common shares. What the trust allows us to do from the date of the establishment of that trust, we now have 21 years to transfer those shares to a trust beneficiary at original cost. So that means the original cost is zero, so there'd be no tax on that transfer. So that really buys Fred a lot of time here, because he calls Lamont the big dummy. So he doesn't want Lamont to have those shares today, but he wants Lamont to have the shares at some point down the road so the business can continue on in the family. So we've got 21 years to do that. If we don't get those shares out by the 21st anniversary of the trust, there's a deemed disposition or sale of those shares inside the trust, and the trust would be liable for the tax on that deemed sale. So we certainly don't want to have that. And then finally, you have a question there, Winnie?
Yeah. So I guess, when I started learning about trust, one of the thoughts that got stuck in my head was, okay, 21 years. I mean, a lot can happen in 21 years. And so, I mean, beside the person who opened up the trust and the holding company, I guess, sometimes our memories or our systems of knowing how much time has passed, who keeps track of the 21 years? Like, does CRA end up knowing when the 21 years is up? Or does the lawyer, how does one actually keep track of that?
Keep track of that?
Yeah.
But yeah. Whenever you talk to accountants, they always say we've got so many years in this trust. They're watching that because they're typically the ones, the tax advisors, the ones that have set this up. So now the clock is ticking. So they know how much time we've got left. It's rare that you run into a tax advisor who will say, we did this at some point. I can't remember when that was done. That just doesn't happen because the liability on that tax advisor would be huge. If the tax advisor forgot and we hit that 21 years and there was a deemed disposition, that would be a significant liability, I would think, to the tax advisor.
Wow. That's something I actually didn't realize. So I suppose then choosing the right accountant that has a plan, or at least some sort of succession plan because what if you get an accountant and he's about to retire?
Yeah, and hopefully that accountant would sell the business or transition the business to another accountant that knows what they're doing. So, it's really important when you're doing this kind of planning, you're speaking with tax advisors that are very familiar with this kind of planning. And not all accountants are involved in this kind of planning. So, a lot of accountants, and there's many, many good ones out there, but many of them are tax filers. They file your tax return, create your financial statements, but they're not involved in this kind of planning. So it's really important that you're dealing with somebody that is familiar with the different structures and how to structure your affairs in a way to accomplish some of the things that we're trying to accomplish here with Fred. So if you're dealing with a major firm, I'll use just some MMP, KPMG, Ernst & Young, BDO, they all have accountants in those firms they call them tax accountants. They've got special training in the tax field that they're trained to do this kind of work.
Amazing. Thank you so much.
Okay. And then the last thing Fred wants to do is, remember what he said? He said, whatever you do, don't mess me up here. Don't create adverse risk or expose me to risks that I'm not exposed to today. And I want to make sure I maintain control. So if Lamont ends up marrying somebody and that divorce or that marriage ends in divorce, and I certainly don't want to see the company go down the drain because of a claim on business assets, because of a creditor problem or a marriage that's failed with Lamont. So this is a fairly common structure, folks. I'm not sure how many of you have seen these, but again, this is a Section 86 freeze, but it's a great way to freeze up the value of the business today, pass the future growth onto the next generation without giving them control or equity in it today. And you don't have to wait until the 21st year to do that. You can do that at any point. These trusts are fully discretionary. So you can decide when that's going to be done. And you might say, hey, in 10 years, Lamont's ready to take it over. Let's transfer those growth shares out to Lamont. All that happens tax-free. The other thing this does is it allows us to extract investment assets out of the active company and make sure it's kept clean for the capital gains exemption. So we move those assets into Holdco. And then inside Holdco, you can buy your real estate, buy investment funds, buy your insurance. All your investments would go in the holding company.
So I would say, like, because our audience is ranchers and farmers here, is there anything that is, if you're sitting there listening and, maybe you don't have a junk company, but you got equipment and all that, right? So is there anything different for them?
The structure might be the same, but the objectives tend to be a little different because, with farming and ranching companies, the statistics tell us that 75% of farm and ranch families expect to transition the business to the next generation. If you're a Sanford and Son salvage company, a regular company, that's about 25%. That's a huge difference. So when you're dealing with ranching and farming families, the question is that, how do we transition this equity onto the next generation? Because nobody's going to come along, and we don't expect or want anybody to come along and buy our ranch or our farm. Now, we might be in a situation where we have no choice but to sell it, but nobody comes along and buys the shares of your farm. So in this case, let's say Fred was a farmer, a rancher here, and he did this freeze. It would still make sense because we're freezing the value of the ranch company, and at $2 million, putting the growth shares in the trust. That gives us still that $2 million. We can set up the holding company, move investments into the holding company. And so on death or at some point down the road, it's usually on death, then the rancher who owns the preferred shares can roll those preferred shares onto the children or child that's running the ranch or owns the ranch. And that can be done tax-free. So Fred can't do that. So the circumstance is a little bit different because we can kick the tax bill down the road with a farm and ranch family. We can't do that with a regular company. But with a farm and ranch company, and the thing with Fred and Lamont here, there are no other kids. So that makes it a little bit simpler because Lamont is the only one coming in. We don't have to figure out, okay, how do we recognize the interests of the other kids? If we have other kids, Fred might say, well, gee, Lamont, you're getting the business here, but I should be recognizing my other children to some extent in their interest in the family wealth. And that's where we can put investments inside Holdco or insurance inside Holdco to provide recognition to those other children.
Thank you so much. Yeah, like that really helps to clear things up, I think, because I kept thinking about, okay, yeah, like in a holding company, it would, that's where I think a lot of I'm assuming that's where the equipment would go. That's where the land would go. Oh, we got like tons of us. You just have to stop sharing.
Yeah, I'm going to stop sharing. Then it'll be just one of us. There we go.
Okay. So, one of the things that I didn't mention right at the top, I again go back to part 1 of our podcast. I do a full introduction, but if you're wondering this whole entire time and you didn't listen to part 1, you're like, who is this guy? Who is Chris? Right? And Chris does have a load of experience. He joins us with Equitable Life of Canada as an advanced case coordinator, but he's like got 40 plus years of, financial experience. And, I'm probably not doing it all justice. So you can add on to who you are.
Yeah, Winnie, thanks for that. It's, I've been doing this for a long time, but it's important that the audience know that, I'm not a tax lawyer. I'm not an accountant. I certainly work with lots of those tax professionals trying to figure out, how do we organize things and how do we use the different tools and investment products available to us to accomplish a family's goals. So we all play a very important part. The lawyer plays an important part. The accountant plays an important part. You as a financial advisor, the insurance advisor, we all play an important part. I'm really here just as a coach and a consultant to provide some guidance wherever I can.
Well, yes. And actually, I just remember now, Chris, you also have, your family is walking into the 6th generation as a farm.
Right.
In Saskatchewan. So, you play a role in all that and seeing it happen, like how it got passed on successfully over the past 6 generations.
Yeah. We're just going into the 6th generation now, hopefully going into the 6th generation. I know that my brother and his wife, they had 4 kids and all those kids are having a bunch of kids. So there's certainly other kids that be in the next 6th generation. But it's funny with our farm, yes, we're 6th generation, but that's not because every generation was successful at transitioning. Farming in the ranch world, you don't have to go back that far where there was really no planning done. Is that usually it was the oldest son took it over and the other kids went on and did their thing. But now, values of ranch, farm and ranch businesses are so significant. Tax becomes an issue. There's much more formality in terms of the transition and making sure everybody's interests are recognized in that whole process. So it's a much more formal process now.
Yeah, absolutely. And then I think that one of the other things that our listeners may or may not be aware of is because we have access to Chris. You can just call up Chris and see him personally. So, when you could, for all of our existing clients, when you're really getting more serious about advanced estate planning, Chris is like Lacey and I really do lean in on Chris to really help us not only educate ourselves, but educate you, but also really help brainstorm and collaborate on what your next best move would be based on your goals.
Yeah, I do a lot of those meetings, Winnie, where you and I connect on Zoom with your client and I end up asking a lot of questions. I just want to know a lot about the business, a lot about the family. And then from that, we try and figure out, okay, how do we start moving this thing in a direction that's going to have a positive result?
Mm-hmm. So I guess to close off our session for today, what would be like something that you would suggest? Because we know that, everyone plays a role, as you were saying. And so we kind of started alluding to it a little bit before in terms of like the accountant and what would you suggest? But how about a lawyer?
Yeah, you need everybody, Winnie. Everybody plays a role. I guess the one point I need to make here is somebody needs to coordinate the process. You have to pick one of those advisors to coordinate the process, because the danger I sometimes see is that a family will say, okay, I've talked to my investment advisor, my insurance advisor. Now I'm going to go and talk to my accountant. Now I'm going to go talk to my lawyer. Now I'm going to go talk to my banker. And then I'll talk to somebody at Coffee Row about this. And we have a number of conversations going on, but they're all independent of one another. So the thing is organizing your advisory team. And that's usually going to be your lawyer or your accountant, your investment advisor, insurance advisor. That's where it starts. And sometimes they're professional organizers. I know that there's some people that all their business is coordinating the advisory team and keeping the conversation going. That's all they do. That's all they get paid to do. So somebody on the team needs to do that. Otherwise, you end up with all these multiple conversations. And when you have multiple conversations going on, you just end up with noise. The point is the advisory team needs to collaborate. They need to get their heads together and say, okay, what is the family trying to do? What are our objectives and priorities? And how do we use our various tools and resources and intelligence to do that? Because everybody comes at the problem from a different perspective.
I love that. I love that you mentioned that because it is 100% true. And you get like a person, I've seen it so many times where an individual or a couple gets so stuck, paralyzed from just trying to figure it all out, trying to discern what is the best course of action, because it could be different from, like, the lawyer could not be necessarily agreeing with what the accountant is saying, but not necessarily not agreeing, but not because they're not understanding each other.
Yeah.
Right. So at some point, getting everyone together should be an ultimate goal to ensure that you feel like you're going all in the same direction.
Yeah, you got to be going in the same direction. I'm dealing with a family right now, and there are 6 people in the family, 5 kids and a mom, and they're trying to figure out what to do. And the good thing is that they're a very close family. They care about each other. They care about the operation, and they want to make sure the operation stays in place. So they come to me through an advisor like you, and we have a Zoom meeting with the whole family on the Zoom meeting. And we just talk about what it is they're trying to accomplish and what's important to them. And they connected me to their accountant. So now I'm working with their accountant and doing the valuation of the various assets and trying to figure out, how do we move these assets and take advantage of all the tax things that we talk about here today.
Yeah. And, with that being said, I will just say this. I actively do my very best to be an open communicator. And I don't mind, like, for those of you who are my existing clients, I don't mind. I mean, if you didn't really know before, if I haven't advocated for it, I am very much a person who can help coordinate such a session, like the meeting of the minds with all the different professionals. So with that being said, though, we are definitely at time. You've provided so much good information. Chris, thank you so much once again for sharing the Sanford & Sons and just to help us wrap our mind. And I know it's just going to really help move some people forward for sure.
My pleasure, Winnie. Always fun doing this with you.
So glad you leaned in with us on the Winnie podcast. We truly hope you're feeling more informed and empowered to take another step towards optimizing your financial life. Right now, make sure you hit subscribe so you can keep growing and learning with us. Until next time, we wish you prosperity in every area of your life.